Alert! The Central Bank of China has opened Pandora's box. The best escape is in these few days. Nomura Securities. The risk of a Chinese stock market crash is rising rapidly. Zhongnanhai's last-ditch move. Drain the pond and take away all the remaining fish. The Twitter account xuanlc.eth.lens is a blogger followed by many Chinese people. The author often provides realistic commentary on the current Chinese economy. The latest article, discussing the impact on the foreign exchange market, stock market, and real estate market in mainland China, has been widely shared among Chinese people. At the beginning of the article, the author said, "Originally, I planned to write a macroeconomic analysis over these 2 days, but now I have too many followers, and I'm afraid of being reported, so I won't publish it. After all, if you follow Teacher Lee on Twitter, you might get invited for tea." Let me just briefly touch on the topic. This epic monetary release has essentially started printing money without an anchor. This breaks the bottom line set by former Prime Minister Zhu Rongji during the 1994 financial reforms, which had remained intact for the past 30 years. Now, with the economy in such poor shape, Pandora's box has been opened. If money continues to be released without limits, only one among the exchange rate, stock market, or real estate market can be saved: exchange rate. The RMB does not have the conditions for appreciation. The previous 7th point, 3-key point, was waiting for the U.S. interest rate cut. However, after the cut, the U.S.-China interest rate gap has not narrowed, but instead has given China some easing room. The continued outflow of foreign capital will not change, and foreign trade is also continuing to shrink. This time, the sharp appreciation of the RMB occurred because it took advantage of the U.S. interest rate cut to withdraw liquidity massively from the offshore RMB market, guiding the appreciation of the domestic exchange rate. This tactic cannot last long, and at most it will reach 6.95 to 6.9. Stock market. Since I started writing on Mirror in 2021, I have always emphasized that every rebound in A-shares is the last chance to escape. This wave of policies aims to make retail investors use all their bank deposits to leverage stocks, and there is a high probability that they will end up with a mess. I think the week after National Day is the best time to exit. It will be difficult to break through 3,300 during this wave, with an upper limit of 3,500. Now many people are shouting for 4,000 or 5,000 points, which is either ignorant or malicious. Xi'an borrowed 1 trillion yuan to protect the stock market at the beginning of the year and accumulated a lot of shares below 3,000 points. These shares need to be passed on to retail investors. Real estate market. The 2 largest waves of increases in China's real estate market were the monetization of shantytown renovation and price hikes to reduce inventory in 2016 to 2017, which caused housing prices to double in 2 years. The second was the large-scale monetary release in 2019 to 2020, which led to at least a 50% increase. Starting from the high point in 2021, housing prices in cities like Shenzhen and Hangzhou, which are leveraged for real estate speculation, have basically fallen back to the 2016 to 2017 levels, trapping most people. Shanghai and Beijing are slightly better, likely at 2018 to 2019 levels. I think Shenzhen and Hangzhou will at least return to their pre-2016 price levels, while Shanghai and Beijing will return to their 2016 to 2017 levels before stabilizing. At the end of the article, the author gives investment advice to people in mainland China. Don't buy stocks or real estate. If possible, convert RMB into US dollars or US dollar-denominated assets. If there are no other options, buy physical gold in China, which not only avoids RMB exchange rate risks, but also hedges against geopolitical risks. Nomura Securities. The risk of a Chinese stock market crash is rising rapidly. Last week, Chinese Communist Party authorities introduced a series of measures to boost the weak economy, including cutting bank reserve requirements, allowing millions of homeowners to renegotiate with lenders, and lowering mortgage rates. These measures have driven a rebound in Chinese stocks, and many investors are optimistic that China's stock market will enter a bull market. However, economists at Nomura Securities warned that investors should soberly assess and prepare for a sharp decline following the rebound in Chinese stocks, as the current economic foundation is much weaker than before the COVID-19 pandemic. In the most pessimistic scenario, the stock market mania will be followed by a crash, similar to what happened in 2015. Economists led by Ting Lu wrote in a note to clients on Thursday, October 3rd. They warned that a bubble in the Chinese stock market is brewing, and the probability of a pessimistic outcome may be much higher than a more optimistic scenario. In the coming weeks, the risk of China repeating the ups and downs of 2015 will rise rapidly. On Monday, China's benchmark stock index posted its biggest gain since 2008, before the country's stock market closed for the National Day holiday. On Wednesday, Hong Kong's benchmark Hang Seng Index surged for a 13th straight day before retreating on Thursday, spreading market optimism. However, economists at Nomura Securities cautioned, while investors can still indulge in the current enthusiasm, a more sober assessment is needed. They noted that the nearly 4-year real estate crisis, high local government debt, escalating geopolitical tensions, the bursting of the investment bubble in the new energy sector, and the sharp decline in trust between the public and private sectors have all contributed to the fragility of the economy. If the rebound turns to depression, it could be worse than expected, with massive capital flight and depreciation pressure on the renminbi. Nomura warned investors that after enjoying the initial rally, they may need to prepare for the worst scenario. Neo Wang, managing director of China research at Evercore ISI in New York, believes a repeat of the 2015 stock market crash would be too much for the Communist Party leadership to bear. Zhong Nanhai's last-ditch move: drain the pond and take away all the remaining fish. The tweet on the 25th commenting on this round of stock market rebound oversimplified the CCP's big scam this time. Things are much more complicated and dangerous than we imagined. The CCP wants to drain the pond and take away all the remaining fish. The main manifestation of the CCP's economic crisis at present is deflation. The entire economy is trapped in a deflationary cycle and cannot move. The root cause of this deflation is the stagnation of consumption. No one is paying the bills. The money in residents' hands is either kept in the bank or held at home in cash. Everyone is holding on to their currency and waiting. The reasons for this stagnation in consumption are threefold. A. The extremely high rate of large-scale unemployment. B. A sharp decline in residents' income. C. A drastic drop in residents' consumption expectations to freezing levels. These three factors are caused by a sharp decline in investment, large-scale flight of foreign capital, and the widespread closure of factories. The CCP's economic crisis is worsening along this chain of links. According to the latest official data from the CCP, from January to July this year, the total amount of resident savings exceeded 147 trillion yuan, not including the cash held at home outside the banking system. In the CCP's view, the key to pulling the economy out of the deflationary quagmire is to force out more than 10 trillion yuan of residents' deposits and invest it in the consumption sector. Instead of addressing the root causes of the economic crisis within the political and economic system, the CCP is targeting the last bit of life-saving money in the hands of the people. How will they do it? The CCP has come up with a strategy to print money at full capacity while reducing the reserve requirement ratio, lowering interest rates, reducing mortgage interest rates, cutting down payment ratios for home purchases, and opening up financial institutions to pledge financing in the stock market. The intensity of this monetary release is the largest since the 4 trillion investment of 2008 and will exceed that level. However, the 4 trillion investment in 2008 was meant to hedge against the impact of the U.S. financial crisis, whereas now, the US and the entire Western economy are booming without any crisis. Therefore, this massive money release has nothing to do with the Western economy and is purely the CCP's own water release therapy. However, due to the severely distorted internal structure of the CCP's economy, all market economy elements have lost their normal transmission function within the CCP system. Market forces, represented by the private sector, have been severely weakened under long-term, harsh suppression by Xi's regime. As a result, the large amount of money issued by the central bank cannot enter the real economy and ultimately fails to generate income or stimulate consumption. The fire of consumption has been extinguished in the cold winds of the Great Depression. This has led to a terrifying phenomenon unprecedented in economic history. On one side, there is a flood of over-issued money. On the other side, there is an extremely sluggish consumer market, dry and barren. In the middle of this ice and fire stands a dam called expectations and confidence of the payers. This dam effectively blocks the money flood from entering the consumption sector. The overissued money cannot be released and remains idle in the bank's own accounts, with banks simply playing by themselves. Over time, the flood accumulates, leading to a situation similar to a patient with uremia. The bladder grows larger, but the urine cannot be discharged. If a solution is not found, the CCP will be suffocated by its own overissued money flood. The CCP's intention is clear. They want to create the illusion that prices, housing prices, and the stock market will soar by converting deflation into inflation, causing people to fear that their money will depreciate quickly. This will induce panic, prompting people to take their money out of the bank and spend it, or exchange it for goods. In order to maintain and increase the value of their money, people will pour their life savings into the housing and stock markets, thereby taking over the CCP's rotten assets at the peak of the bubble. Remember, the more than 10 trillion yuan in resident savings is no small sum. If the CCP successfully converts these deposits into spending, it will be enough to pull the CCP's economy out of the deflationary quagmire, giving the regime another deceptive escape. The CCP will have used every trick to defraud the people, driving them like cattle to the slaughterhouse in this shameless scheme. If the CCP succeeds, they will gain at least 5 more years of survival, but the people will pay a heavy price, losing all their money. So, will the CCP succeed this time? It's hard to say. It depends on the people's awareness when watching the con unfold, their level of greed and desire, and ultimately, how much trust they still have in the CCP. Will the people trust the CCP once again?